Mortgage Insurance Committee is approving modifications to mortgage insurance and a commitment for the provision thereof for 3900 Park Avenue, Bronx County. Assuming the first and second previously entered, all in favor, please signify by saying aye.
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 The motion is carried.
Item 6 is an informational item from Mike.
Just the mortgage recording tax in February was $14.5 million, which is greater than it was in the same month in either 17 or 16. But within this fiscal year, the mortgage recording tax seems to alternate between 12 and 14 million a month. There's really been no discernible trend within the year. However, for the first 11 months of the year, it's 146 million as compared with 161 million last year and 172 million 2 years ago. So the overall trend is downward.
And just again, in case, I mean, I like being reminded, but because Jonathan is new to the committee, could you remind us of the importance of the connection between the MRT collections and our work?
We receive the monthly mortgage recording tax from all 62 counties. That's held in an account that's not a mortgage reserve account. It's essentially a payable to the state of New York unless those monies are used as reserves for new commitments or new claims. And so we need an adequate amount of mortgage recording surtax to provide reserves for new commitments and new claims. And this is an adequate amount. And as of March 31st, anything remaining in that account in excess of what we've needed for new reserves and operating expenses reverts to the state. Although
Go ahead.
I would say, by statute, anything left in the account on March 31st is payable to New York State. Although in the past 5 years, the executive budget has designated it for affordable housing subsidy.
What happened during the recession or when the MRT really dipped?
There was no excess for housing subsidy. And only in 1 year, I think probably 12, we actually had to cut back on originations of new commitments because we, essentially ran out of money after 11 months.
Thank you.
It comes from all 62 counties, right?
Mm-hmm.
And it's 100% at a
It's
closing when someone pays MRT, 100%?
Except, it's 100% in 49 of the 62 counties. And in 13 of the counties, the 12 counties in the MTA region,
Right.
plus Erie County, the single-family mortgage recording tax is diverted to the MTA and the Niagara Frontier Transportation Authority. But the MIF gets the mortgage recording tax other than single-family. So in New York City, for example, it's the apartment buildings, office buildings, hotels,
Right. But not
but
one
not
to
single
four.
family. The MTA gets around $8 million a month.
MTA is a myriad of taxes and,
Yeah.
But I know that when it dips, there is concern, but it has other taxes and ways
The payroll
to
tax.
get revenue.
The lovely MTA payroll
Yeah,
tax,
all
which
sorts
our HR
of-
department has to grapple with, yeah. Okay, good, thanks, Mike. Lauren, back to you, going to close up?
Okay, then if there's no further business, motion to adjourn.
So moved.
Assuming the first and second previously entered, all in favor, please signify by saying aye.
Aye.
The motion is carried and the meeting is adjourned.
Great, thank you, Lauren.
Thank you.
Mike, thank you. Probably soon see you again. We'll now begin our meeting of the directors of the New York State Housing Finance Agency, the New York State Affordable Housing Corporation, and the State of New York Mortgage Agency. Good morning, everyone, again. And again, we sort of did this last time, but I want to introduce Jonathan Ballin, who, as folks have figured out, between meetings joined the Mortgage Insurance Committee, so thank you for that. And thank you again, Jonathan, for your service and for joining us today. Welcome aboard. Linda, you want to, let's just jump right into it and get started.
Great. I note that Todd Sherman, representing the Director of Division of Budget, and Eric Mostrat, representing the Commissioner of Taxation and Finance, are participating in the meeting via video conference from the New York State Division of the Budget Conference Center at the Capitol Building 131 in Albany. Good morning, gentlemen.
Good morning.
Good morning.
And Bethaida Gonzalez is participating from the Syracuse Regional Office, 620 Erie Boulevard, Suite 312. Good morning, Bethaida.
Good morning.
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 Notice of these locations have been made public, and the public has the right to attend and observe the proceedings from either location. I will ask for motions and seconds to call to order the March 8, 2018 meetings of the New York State Housing Finance Agency, New York State Affordable Housing Corporation, and the State of New York Mortgage Agency. Can I have a motion, please, for HFA and AHC?
So moved.
Second.
Thank you. And a motion for Sunny May, please?
So moved.
And a second?
Second.
Thank you. As items are presented to each board throughout today's meeting, these motions and seconds will be used unless specific items call for a different vote or unless any member or director wishes to record his or her vote differently.
Linda, thank you for getting us started this morning. I now turn things over to Ruth Ann Visnauskas, our president, for her president's report.
Thank you, Ken, and good morning, everybody. We have a full agenda today. So at the Mortgage Insurance Committee, 4 new projects were approved for insurance for a total of 164 units of affordable housing in Onondaga, Kings, and Dutchess counties. And in a few minutes on the HFA agenda, we'll be seeking your approval on 2 new financings, so not a super long agenda, for projects located in Sullivan and Ontario counties for 119 units of affordable housing. Also, we have a couple of administrative items that we're going to address this morning. Since my last report in January, we've been a bit busy. We are sort of on the precipice of moving forward with the large Vital Brooklyn initiative. So we've had a large number of meetings with the state elected officials whose areas are within the Vital Brooklyn catchment area about the project and are looking forward to releasing some RFPs in the near term. At the end of January, which seems sort of like 100 years ago now, we went up to Plattsburgh. There was a mobile home park that had some severe flooding, and about 70 mobile homes were impacted. And so the governor went up, as did Senator Betty Little, who is the chair of the Housing Committee. And we've been working very closely with both the chamber and with the owner of the park to try and see if there's an intervention that we can make to help the homeowners there whose homes suffered damage. In early February, I went up to the Independent Living Center of the Hudson Valley, which was a wonderful project that we have given a bunch of programmatic subsidies to. It's a center for people who have mobility challenges and sort of helps work people through independent living, those mobility challenges. It was a very nice event. And lastly, on Monday and Tuesday of this week, I was in DC for the National Council of State Housing Finance Agency, also known as NCSHA's LEDGE conference. So that involved a bunch of sort of executive director meetings and some folks from HUD and other executive agencies coming and talking about the federal budget, us being able to talk about our priorities. We also met with a series of staffers from our congressional delegation, including Schumer's office, Gillibrand's office, Joe Crowley, Nita Lowy, Meeks, Claudia Tenney, Dan Donovan. We did some of that with New York City housing officials and some of it we did on our own, but to basically talk about the $8.8 billion proposed cut in the president's budget for HUD, which is dramatic and impacts us both on CDBG, on home, on Section 8, and on public housing. So we sort of went to make sure our voice was heard, that we're not in support of a cut to those programs, and they have a big impact across the state. We also talked about some legislation that we would are trying to get sort of support for, that would expand the housing credit. So obviously, as everybody knows, in the wake of tax reform, we are seeing a lot of gaps in our projects as a result of tax credit pricing. And there has been a bill that was sitting, that has been around for a year or two, sometimes called the Cantwell, or often referred to as the Cantwell-Hatch bill. So Maria Cantwell and Orrin Hatch. So it's a bipartisan bill to expand the housing credit. So we think it has some legs, and we are trying to see if in any of the, in the omnibus budget that goes through, or some process outside of that, if there's a chance that that gets passed, it would sort of help us fill the gap and actually be additive. So we talked mainly to all of those congressionals about the budget and about the bill that would expand the housing credit. And that's about it for me. Back to you.
Ruth Ann, just a quick question. Is the problem the drop in, sort of a reduction in the value of the low-income housing tax credits, as we've discussed before, we talked about in December. Not so much the volume, the issuance to it was 8 billion, whatever the number is that is divvied up amongst the states, right? So there's a quantity and a quality issue, right?
Yeah.
So how would you?
So on
break that
on the tax credit side, the lowering of the corporate tax rate just has reduced people's need for. So the credit is everyone sort of a dollar for dollar loss against taxes, but owners also take depreciation and losses from the property. So when they no longer really need all that depreciation and those losses, then they will pay less. So we saw in New York City these drops from like $1.20 to $1.05. Upstate, we might have been at $1.05, $1.10. We're seeing like 90 cents, even sort of south of 90 cents, in those projects. So it's significant gaps. We think on an annual basis, it's about a $200 million loss of equity, which for us is about 1,500 units of housing, which is a lot. As an agency that's doing
$200 million to the state of New York alone.
Yes, to the state of New York alone. But then our numbers are big. I mean, on the Section 8 cuts, we have the biggest impact nationally, where the proposed cut that's in the president budget would result in a loss in New York State of 20,000 vouchers. And 20,000 vouchers is not a voucher loss that we can absorb by just attrition and not sort of renewing. It would be a taking vouchers out of people's hands, sort of that place you never want to get. Now, the president's budget obviously is not where people think we're going to end up, but even anything between 0 and 20 is certainly a harsh thing for us to absorb, and is just generally sort of an overall kind of shrinkage of all these programs, because a lot of them obviously they're kind of year over year programs. So right when you look back at the last year and it gets shrunk, then it sort of keeps going and has kind of a domino effect. Yeah, Joyce?
Going back to the low-income housing tax credits, the tax credits which have previously been issued and syndicated, sold, etc., the investors in those tax credits will also have a loss in the value of the credits, correct?
Yes, but since the projects are closed and those commitments have been made,
I know it's not going to affect the project,
Correct.
it's just going to affect the investors.
Yes, right, and which is they're looking
Yes.
at obviously existing commitments they've made as they look at future commitments.
They
right?
could
So
lose
that's
their
driving-
appetite, right?
Right.
Yeah, well, I
New
was
projects.
thinking that, given that tax credits have been in existence for so long, and they had become a regular part of the program and accepted as such, and sort of an assumption was made that they were just going to continue. The fact that the tax law was changed such as to devalue the tax credits, I'm wondering if at some point in the future, if the tax law was again to be revised in such a way that the credits would increase in value, it would also create, I think, marketing problems, because they've now seen that they can lose value
Right.
after they've been purchased.
Yeah, I mean, I think all things in government, you always want the private sector to have confidence that they're going to be
Yeah.
there. And when you start to mess around with that confidence, it's hard to do business.
Yeah, predictability really matters to have long-term investors, right? But let's also remember that tax credits, from the government's point of view, are a tax expenditure. There's two ways to do it, right?
Yeah.
Like, in a high-tax environment, sell tax credits, right, and basically refund or forego tax revenue, or have lower taxes, right? I mean, or actually do direct, like Section 8, do direct subsidy. So it's a balance between the two, but it sounds like, well, that's helpful, Ruth Ann. The last question related to that, again, when we talked last time before the holidays about the prospects of the tax bill, there was also, and I know you were very concerned about this, the risk that there be a reduction of private activity bonds. And I think you said that didn't come to pass, but is that still a fear, and what's the situation nationally there? I'm sure it came up in your discussions Monday and Tuesday.
It did not come to pass, which was great. The thing that I think is in the ether now, which is mostly just in the ether and sort of hard to talk about in specifics, is the infrastructure bill. There have been sort of pieces that have come out. There's a lot of private activity bond language in the infrastructure bill, but we don't think it is housing. Like it might be a new private. There's this language to eliminate the cap.
Yeah.
Which we said, great, that would be wonderful, but then it's sort of, we kind of get messaging like, well, that doesn't actually apply to you. It's going to be for some other sort of, roads, bridges, and not housing, and so we don't. So we feel protected and we are issuing, we've been in the market and, you know, and there's been no sort of blips in the market, from our perspective on being able to issue bonds and, but that's, I think, the only piece that maybe is hanging out there, whether or not an infrastructure
Right, but it,
actually plays out.
I guess there could be a situation which would not be ideal, where there was competition for projects, for
Yeah.
private activity bonds, and you'd be pitting infrastructure projects against affordable housing.
Yes, no, for sure. That would be an issue.
That would be an issue.
Ken, one thing that I have to follow, I follow this, you know, for my profession. The chairman of Ways and Means, Brady, gave an interview and said some very troubling things relatively recently about cutting back on private activity
Yep.
bonds, particularly if they're gonna find room for more, for infrastructure bonds. So at some point, maybe, you know, sidebar away, we can discuss that. But I think the notion of making sure that people keep doing what you described you did to our elected officials, particularly in Washington, is very important, because they really don't, as it was revealed last fall, they don't really understand, nor, they got a lot of issues going on, I get it.
Right,
They don't
right.
really understand that private activity bonds aren't necessarily solely for private activity, that it was a term of art that someone invented in '86 or in the mid-'80s when they did the Tax Reform Act. They used to be called industrial development bonds. There's a long history. But we need to keep up the educational efforts and pressure, because first time you turn your head, they're gonna come after it when they're looking for revenue.
Yeah.
At least that's my view.
I think that's 100% right, and we also heard when we were down there that even people who are steeped in this, and it is, the IRS code is I think section 42, someone said, is the longest section of the code. It is very sort of wonky and long. That when people were in late fall of last year, talking about the tax credit, people were really just talking about it was really, the language in there was about the 9% credit, and people didn't really realize that about the 4, because the 4 isn't really like in the same section as the, so even people I think who are steeped in it still miss things in the nuance of the 9 versus the 4, the private activity bonds and the 4s.
And there's also a intellectual bias against tax exempt finance that has existed long before I started. And it's there for a lot of historical reasons that are not worth going into now. But anything you can do to keep up the educational efforts, I think, are really important.
Thanks.
Thanks, Jonathan. All right, well,
Very helpful report. Yes?
Yeah, no, I was just going to say that in the days when I was working on infrastructure financing and the concept of a national infrastructure bank and dealing with a lot of committee staff, it was very quickly apparent that they really did not understand finance. They were lawyers and with no background in finance, which made it very difficult to explain things to them.
Yep. Maybe we'll just take 1 minute actually to add one additional thing, since I won't see folks till after the budget passes, and I don't know if this will come to bear, but there has been, so right now we have the state low-income housing credit, right? So there's about $8 million a year that we allocate in the state credit. The state credit and the federal credit go together. And many states that have a state credit have bifurcated the federal credit from the state credit to allow them to be able to use by different entities. I think there's 14 or 16 states that have a state credit, and like there's only 2 that don't bifurcate it, which is us and another state that I can't remember at the moment. And so what it would do is it would increase demands on the state side, because a lot of times people who are buying the federal credit don't necessarily have a state credit to use as an offset, so it's not that valuable for them. So if we bifurcate them, then the pricing of the state credit will go up. And so there's legislation that was introduced in the Assembly, I think this week, and I think it's in the Senate also, to allow the state credit to be bifurcated from the federal credit, which would help us, and it would bring more equity into the projects. We'll see how it goes in this legislative session, and we can talk about that next month.
Have there been attempts to do that in the past? It sounds like pretty obvious.
My understanding is that there is if you are a tax, maybe this is also like a governmental tax person, you have I don't know what the word is, but sort of like an ethos about taxes in which you feel that state and federal should always travel together, and bifurcating them is something that people don't like, who spend a lot of time thinking about the tax code, which I do not. So our understanding was that as it has been brought up in the past, there has not been a desire to do that, because it just sort of is like a fundamental for folks that they be together. Todd, if I'm overstating, jump in. So it has been sort of around, but it has not gotten traction until we're now in this sort of more dire state post-tax reform. So we'll see.
All right. Great. Joyce, or Nestor, any questions?
thanks for the report, and my guess is we'll continue to discuss these in our next meeting and upcoming meetings. Linda, would you do the honors and take us through the committee work?
Happily. The report of the Mortgage Insurance Committee after adopting the minutes of the January 25th, 2018 meeting. The committee took the following actions early today. Recommended 100% mortgage insurance on a $7,725,000 Wells Fargo permanent first mortgage loan for Deborah Boyce Senior Housing, Brooklyn, Kings County. Approved 100% mortgage insurance on a $4 million CPC permanent first mortgage loan for West End Lofts, Beacon, Dutchess County. Approved 100% mortgage insurance on a $2,031,178 CPC permanent first mortgage loan for 476-80 South Salina Street, Syracuse, Onondaga County. Approved a $650,000 increase in mortgage insurance on an HFA permanent first mortgage loan for 3500 Park Avenue project in Bronx County.
We're now going to present items that are shared by HFA, AHC, and Sunny May. And Linda will start off by recording the approval of the minutes.
The minutes of the meetings of the HFA, AHC, and Sunny May boards held on January 25th, 2018, and on February 22nd, 2018, shall be deemed approved absent correction from the members and directors.
Linda will now take the requisite steps to go into executive session.
I'll ask for a motion and a second to go into executive session pursuant to clauses E, F, and H of section 105(1) of the Open Meetings Law to discuss collective bargaining negotiations, the proposed lease of real property, and the financial history of a particular corporation. Do I have a motion
So moved.
and a second? Thank you. We'll now go into executive session. If it's all right with the chairman, I'm going to ask for a motion and a second to go back into regular session.
So moved.
Second?
Second.
I just wanted, for the record, let everybody know that no votes were taken in executive session.
Linda, thank you. We're going to move to the shared action items. Item 2 has been withdrawn from the agenda. Item 3 is approval of the agency's integrated employee handbook. And our ethics officer, Ms. Farina, is going to present it. Good morning.
Good morning. Good morning, everyone. Hi. Before you today is our integrated handbook. It's the result of a 3-year joint project between the HR staff and the Office of Legal Affairs. Originally, HCR had separate employee handbooks for every payroll. So there was a separate handbook for AHC, HFA, Sunny May, and the DHCR side of things as well. So now we have one streamlined version that consolidates down all of the handbooks, and it highlights where the policies are consistent and then also clarifies where the policies differ. Prior to implementing the handbook, we circulated the draft handbook to all of the unions that are represented here at HCR for the review and comment. And also, because the handbook applies to the state side of the agency, we also had the handbook reviewed and vetted by Civil Service and the Governor's Office of Employee Relations. So once that was completed, we then emailed the handbook out to agency-wide in the middle of September, and we also published it up on our intranet page. So it's there, accessible now for all of the employees, searchable and downloadable and easily accessible for everybody. Most of the policies in the handbook have remained the same from all of the prior handbooks, and you'll see just by looking at the table of contents, there's really nothing out of the ordinary from your usual standard employee handbook. 2 new policies that were added that didn't exist in any of the prior handbooks were the social media policy and the fraud and theft policy. And just to go back to the union aspect, we also have in the handbook expressly stated that where there's a conflict between the handbook and any of the collective bargaining agreements obviously supersede the handbook. Are there any questions?
Questions from directors about the new handbook?
Just one small one. First of all, this is tremendous, and I can only imagine how much work it took to integrate and sort of smooth out the differences, and I think it looks terrific. Just one question about the paid family leave. I was struck, given how much the state is advertising the importance of paid family. This is not about the handbook, it's about this policy, but I'm just curious, you know, is there a conversation about, I was struck by the fact that it's not available to employees, and you know, setting aside the union issues, I'm just curious whether that's a conversation that the agency is having.
Di, do you wanna?
Sure. The paid family leave was just instituted for MC employees in the state, and it's just been rolled out for that subset. It is available to other entities and groups should they wish to opt in. We are looking at the benefits to our employees of having that and having conversations internally. Which will be ongoing. I mean, we certainly are looking at it.
Diana, just refresh my memory. Does the state have the state must have a carrier for the policies, right? I mean, I know it's just begun, but there's a payroll tax reduction that, you know, pays for the premium to have the paid family. So there's a carrier, and I'm curious how that's working out and who that is.
I can't tell you off the top of my head who that carrier is. I don't know if Todd knows. I don't know who that is off the top of my head. It's very new.
Yeah, that doesn't matter. I just the mechanics of this are going to be interesting across the state to see how it plays out and to see from an actuarial standpoint, you know, the payroll deduction. Is it going to cover the? I mean, there's a lot of. It's a big, bold proposal, and I'm sure for you, Diana, and HR folks here, it's going to be long and complicated. An important benefit to provide, that's not the issue, but the mechanics of it, I think, are still, right, they got to play out. At least that's what you hear from employers, right? And as a reminder, too, FMLA is for employers with 50 or more people, right?
Yeah, correct.
So this is, what's the cutoff? I mean, of course, it affects state agencies that are big, but for businesses out there, does anybody remember? Because I'm sure it's you know, 10 or more or 20 or more. And, you know, again, not our issue, but as a large employer. But so people know what a big impact this has all across, with employers all across the state. I'm sure it rides under FMLA, right? So, in terms of
any full-time employee who works over 20 hours a week, a regular schedule, is eligible to participate in paid family medical leave after they've worked, I think, 26 consecutive weeks of employment.
Thanks, Dana.
Thank you.
Yeah. I just have a question. How long did it take to do this? Because to Nestor's point, this is so much work to do this consolidated handbook.
Well, it took 3 years total. Luckily, I joined just 2 years ago, so I'm sitting over the finish line.
Diana, can you vouch for that? 3 years?
Yeah, we started it when I got here, which is roughly 3 years, and it's been a labor of love with the HR team, and Gabrielle.
Well, and several of these, like just this one example, several of these new benefits for employees and new regulations have occurred or been enacted during that 3-year period. So the ink is drying. Any other questions or directors on this item for Gabrielle? Well done. Congratulations.
Thank you.
So now before all three boards is a resolution of the New York State Mortgage Agency, the New York State Housing Finance Agency, the Affordable Housing Corporation approving the integrated employee handbook, assuming the first and second previously entered for all three agencies. All in favor, please signify by saying aye.
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 The motions are carried and the resolution adopted.
The next item on the agenda is an information item. There will be no discussion on this unless board members or directors so request. Item 4 is current agency procurements in the lobbying restricted period. And anything else on that?
No.
Then we will move to the Sunny May action items for this morning's agenda. Item 5 is a resolution approving 100% mortgage insurance on a $7,725,000 Wells Fargo permanent first mortgage loan for Debevoise Senior Housing, which is in Brooklyn. This item, is this for me to read?
Yeah.
All right. This item was discussed and voted on earlier at today's Mortgage Insurance Committee meeting. That was at like 9 o'clock, a long time ago. And it's now up for vote by the Sunny May Board. There'll be no discussion on the item unless directors so request. So we'll move on to the votes, Linda.
Now before the Sunny May Board for approval is a resolution of the State of New York Mortgage Agency approving mortgage insurance and a commitment for the provision thereof for Deborah Voice Senior Housing, Brooklyn, Kings County. Assuming the first and second previously entered for Sunny May, all in favor, please signify by saying aye.
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 The motions are carried and the resolution adopted.
Item 6 requires Mike Frieden to come back to the table, I think. It's a resolution approving estimated excess balance in the mortgage insurance fund.
Good morning again.
Our annual update.
So pursuant to the Public Authorities Law, Sunny May is required to make a preliminary determination of the mortgage insurance fund's estimated excess balance for the 12-month period ending each March 31st, and to certify this estimated excess balance to the Director of the Budget, the Controller, and the Chairs of Senate Finance and Assembly Ways and Means Committee. The estimated excess balance calculation takes into account monies received from the mortgage recording surtax, monies used for new commitments, new claims, and operating expenses. And based on information for the 11 months to date, we estimate that the estimated excess balance will be $44 million for the period ending March 31st, 2018. And the calculation takes into account declining mortgage recording surtax receipts coupled with a fairly level number of new commitments issued and claims paid. The claims paid are principally single-family pool claims. And the Board of Directors is asked to adopt the attached resolution approving the preliminary determination that the MIF will have an estimated excess balance of $44 million for the year ended March 31st, 2018.
Linda, do we move to a...
So now, if there are no questions,
I just have, what was last year's consent?
Last year, it was 53 and a half.
You see where this trend is going,
Yeah.
David. Any other questions or directors? Questions from directors for Mike on this? Linda?
and now before the board, the Sunny May Board is a resolution of the State of New York Mortgage Agency regarding the estimated excess balance in the mortgage insurance fund for the 12-month period ending March 31, 2018. Assuming the first and second previously entered for Sunny May, all in favor, please signify by saying aye.
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 The motion is carried and the resolution adopted.
Item 7 is thank you, Mike, is a resolution authorizing amendments to the Sunny May Community Restoration Fund's Limited Liability Partnership Agreement. And who is
Sherry's on video.
Good morning,
Sherry-
Sherry
Sherry-
Eccles is joining us
Sherry's
from
on
the
vid-
Capitol.
Where is she? Oh, you're like, oh, it's funny. I looked at Albany, but I
There
didn't
she
see her
is.
there. Hi, Sherry.
Good morning,
Can
Sherry. Sherry, would
push
you-
it a little? We
push yourself into the table a little more because the camera's not picking you up. And
There we
introduce
go.
yourself if you don't mind, and then we look forward to your presentation.
Hi, good morning, everyone. I'm Sherry Eccles. I am the Senior Vice President of Sunny May, and I'm here to talk to you this morning about some proposed amendments to our limited liability corporation agreement with New Jersey Community Capital. So I'll start with just a little bit of background. In June of 2016, legislation was approved to create the Sunny May Community Restoration Fund, and what the entity was designed to do was to purchase pools of defaulted notes at a discounted price and use the difference between the discounted price and the value of the notes to subsidize principal curtailments, forgiveness of arrearages, reduction in interest rates in order to enable these home buyers or homeowners to modify their mortgages into an affordable payment. And predominantly it's intended to help people who are underwater in their mortgages, where they had a loss of property value due to the financial crisis, or they have a permanent loss of income, either through death of a family member or financial impact of the crisis or some other type of circumstance, so that we can stabilize the neighborhoods and keep these people in their houses as much as they can. So in looking at a number of ways to do this, as this is obviously new territory for Sunny May, we created an advisory council. We met with a number of different people. We looked at purchasing some notes on our own, and we found that if we partnered with a group that had experience in this area, not only would we be able to leverage their knowledge, but we would also be able to leverage additional resources and increase the reach of the program. So in June of 2017, we came before the board to have a partnership agreement approved with New Jersey Community Capital. The partnership entity itself is based in New York State. And the reason why we selected New Jersey Community Capital was because there's really only 2 nonprofits that have experience at a national level to the degree that New Jersey Community Capital has. And they have been extremely generous with us in terms of providing knowledge and transparency so that we can learn from this partnership, as well as they've been great at providing additional resources and enabling us to have access to other capital so that we could leverage our $10 million investment with another $112 million and help approximately 570 homeowners at this point. So we originally closed on a pool of 398 notes last summer. And in terms of the results of that so far, we have modified 19 loans. So those are 19 home buyers who are able to stay in their homes. And we have another 63 in process. We've also provided soft landings for 7 people who were unable to stay in the home. There was just no way to get them to a point where they would have a sustainable home ownership situation. So we provided them assistance in moving and getting into someplace that would be sustainable for them. And we're offering 42 vacant properties to nonprofit partners and land banks across the state so that they can fix them up and offer them for sale to qualified home buyers at an affordable price. So for those that were unable to achieve a successful, sustainable outcome and staying in their homes, we're trying to make sure that at least the prices remain stable and affordable for new owner occupants to come into the community. And so we just have been working with NJCC to add another 172 loans, which brings our total to 570. And in the process of doing this, we invested an additional $3 million, bringing our total investment to $10 million in the partnership. And we've, again, as I mentioned, leveraged that with $112 million in private capital. And so the amendments that we felt we wanted to make as part of this additional investment was to just solidify our position in 2 places. The first of which is that when we did the financial modeling on this, we were assuming an average level of assistance of approximately $50,000. And we had established an informal cap of $75,000. So we wanted to codify that to ensure that as we moved forward with this new model, we were, we had an agreement around what we had informally decided in our modeling. So this just puts into the agreement that there is an average $50,000 subsidy per transaction with a cap of $75,000, and also allows for an exception to be done upon review for committee and special circumstances. And the second thing was that under the original partnership agreement, New Jersey Community Capital had the ability to unilaterally declare bankruptcy of the partnership. So we, in order to, again, strengthen our position, added an amendment that requires any bankruptcy filing of the partnership has to be approved not only by New Jersey Community Capital, but also by Sunny Mae. So our ask today is just, since these are changes in the terms of the original partnership agreement that you approved, that you would be willing to consider and approve these amendments.
Thank you very much. It was it's a very good presentation of a truly, it's just a terrific program. Directors, questions for Sherry, right? Sherry?
Yes.
Yeah.
Yeah, I just have questions about the average amounts of the modification assistance of $50,000 and the cap of $75,000. And do we have any idea of how that relates to what the needs are of this population?
Those numbers were actually derived, yes, great. So the numbers were derived from modeling. Once we had an idea of what the pool of notes were that we were working with, we looked at what the arrearage amounts were in terms of how far into default these borrowers are. For those who aren't familiar, once a borrower goes delinquent on a mortgage companies don't accept partial payments. So they're required to pay the entire arrearage in full in order to be made current. And that's a huge impediment for a lot of low-income borrowers because they can't get that full nut to be able to bring themselves current. So those arrearages just continue to accumulate over time. And so part of the assistance includes the forgiveness of arrearage. So we looked at the arrearage amounts, and then we also used automated valuation modeling, AVMs, and BPOs, which are broker price opinions that realtors provided us, to determine what the values of the homes were versus the outstanding principal balance, so that we could get a feel for what, how underwater these transactions were. So looking at those two factors were really the primary drivers in determining what the assistance would be.
Thank you.
Is that helpful, Joyce? Yeah. Directors, other questions for Sherry on this program or the proposed modifications to the agreement? David?
Yeah, at the risk of being a broken record, at the end of the process, there's a certain group of homeowners that are not going to be able to be helped, at least not in the form of helping them continue to own. So then the program, I guess, shifts to relocating them or, completing the foreclosure process. I've long wondered whether there's another avenue that can be traveled down, which would be to cooperate with them in the foreclosure process and turn them into tenants in the end in their own homes, and then sell the property with a tenant rather than selling a vacant home.
And they still have a roof over their head.
Yeah, so I'll give the front end of the question maybe, and Sherry can and answer the second half of it. So we definitely perceived of this going in as, I sort of simply refer to as a third, and a third. So we think a third of the people will get modifications and will stay in their homes. A third are sort of what Sherry described as the 7 that we've done so far, which is people for whom staying in this home, even at a modified mortgage, is not the right outcome, and they need to be in a different housing situation. So they either need to be in a rental or a different priced home. And so that's sort of this sort of soft landing idea. And then there's a third of the homes that either may be vacant, have squatters become vacant, and we need to foreclose on them to clear title. So we sort of went into it knowing that, right, a modification wasn't going to be the right thing for everyone. I think, but Sherry, correct me if I'm wrong, on this idea of either foreclosing or somehow having the nonprofit take title and keeping them as rentals. I think we have talked about that sort of generally, where that would make sense for a nonprofit to own sort of like scattered site, single family rental properties. I think some of them are probably more amenable to it than others. But Sherry, I don't know, feel free to sort of jump in, you know better than I do.
Right, no, that's absolutely right. And one of the prerequisites of the program is all of these notes were assigned to a local nonprofit that is in the community within a couple of miles of these homes. And all the nonprofits have gone and knocked on the doors to have an opportunity to speak one-on-one with these borrowers. These are all nonprofits that are part of the Homeowner Protection Program network that the state had established in order to help people stay in their houses. They are foreclosure prevention experts. They sit down in the living rooms with these people and talk about, what is it that you're hoping, making a determination whether there's any feasible way to keep them there, and then letting them know what resources are available by way of soft landing and helping them connect with other affordable housing. So they are really making every effort. But as Ruth Ann said, there are certain times, I just actually had a meeting in Schenectady on Monday with an organization that's doing this for us there, and there are 3 homeowners out of the notes that they were assigned that are physically sitting in their living room watching TV and just will not answer the door when the person goes and knocks and says, I'm trying to help you save your home. There's a level of distrust. There's also, I think, a fear for some people. And when you're in circumstances where you just can't even communicate with people, it makes it hard to be able to save those homes. The nonprofits, as Ruth Ann mentioned, some of them are amenable to keeping the properties as rentals, and others are trying to stabilize them with owner-occupant tenants that are going to be less transient. So as a result, they want to sell them to keep the owner occupancy rates higher in neighborhoods. And so, I think we have a mixed bag there, and I think that probably about 50-50. Some will wind up being rented out by the nonprofits, and some will wind up as being sold to owner-occupant tenants. A lot of them also need work, so someone would have to move out in order for all the work to be completed and then move back in anyway. So.
And a lot are probably in arrears on their property taxes.
Correct.
Sherry, thank you again. Joyce has one more question.
Yeah, I had one more question, which is simply about the number of loans which have been reviewed and modified or reached some other resolution. Given the number of non-conforming loans, they've purchased 398 non-performing loans, and it looks like they've actually processed less than 150. Do we have any idea of what if there's anything holding up the non-process loans, those loans which haven't been looked at yet, or are those loans which we couldn't for some reason provide assistance?
So in some of these cases, it's access to the homeowner. When these loans closed at the end of June, the servicing was onboarded at the end of August. So outreach by the nonprofits didn't occur until after Labor Day in September. So in certain cases, it's a matter of having conversations with borrowers, and they obviously got the low-hanging, the people who were most responsive in the beginning. And now they're talking to the people that are kind of harder to reach. Some people have already been talking to lawyers and are aware of the foreclosure timeframes in New York. So they know if they're only 18 months delinquent at this point, that they've got at least another 2 years before they're going to face foreclosure. And a lot of them, just the reality of the situation is a lot of them won't really turn and address this or respond to these inquiries until it becomes more urgent for them. And so, part of the modeling of the program was making an assumption that there was going to be a significant chunk that would be responsive immediately, and then there's going to be more over the course of the next 2 years that will be responsive, as the situation becomes more urgent, with an end run modification rate of 40% of the overall notes. And we actually, based on our modeling, are running ahead of what our original estimates were. So that's not to say that the result will wind up 40%. It may just be that more people responded earlier than what we originally anticipated. But as of now, we're actually ahead of what we were expecting.
Okay, so when you say that there are 63 loans which are being processed, that does not really mean that they've looked at 63 loans. They have examined far more than that
Absolutely.
number.
Yeah, absolutely. They've talked to more borrowers than that. They've looked at more loans than that. These are people that actually are approved for a modification and are doing trial payments to be formally modified. So 19 of them have gone through that process and are formally modified, and the rest of them are going through the process.
Great. Any other questions? Joyce, anyone for Sherry? Thanks again for the presentation. Linda?
Now before the board for approval is a resolution of the State of New York Mortgage Agency approving amendments to the limited liability partnership for the Sunny May Community Restoration Fund. Assuming the first and second previously entered for Sunny May, all in favor, please signify by saying aye.
Aye.
The motion is carried. Thank you. I'm sorry, the motions are carried and the resolution is adopted.
Linda, thank you. Thank you again, Sherry.
Thank you.
Now we're going to move on to the HFA items. At this point, Linda's going to call to order the Finance Committee of HFA and Sunny May, which will be held jointly with the HFA and Sunny May board meetings.
I'll ask for motions and seconds to call to order the March 8th, 2018 Finance Committee meetings of the State of New York Finance Agency and the State of New York Mortgage Agency. Is there a motion for the Housing Finance Agency?
So moved.
And a second?
Second.
Thank you. And a motion for Sunny May?
So moved.
Second.
Thank you. The minutes were included in today's board materials and they'll be deemed approved absent any corrections from the board members.
Very good. There being no further items for the Sunny May Board and the Sunny May Finance and Program Committee, Linda's going to ask for a motion and a second to adjourn the Sunny May meetings.
So moved.
And a second?
Second.
Assuming the first and second previously entered the Sunny May Finance Committee, all in favor, please signify by saying aye.
Aye.
The motions are carried and the meeting is adjourned. Assuming the first and second entered for the Sunny May Board, all in favor, please signify by saying aye.
Aye.
The motion is carried and the meeting is adjourned. Our next Sunny May Board meeting is scheduled for Thursday, April 12th at 9 a.m. to be followed by an educational session.
We're now going to move on to the HFA items. Item 8 are resolutions authorizing finance approval of tax-exempt bonds in an amount not to exceed $7,100,000 for Main Street housing, the town of South Fallsburg in Sullivan County.
Good morning.
Morning.
We're going to do 8, 9, and 10.
Excellent.
Item 8, Main Street housing. This is a rehab and preservation of one of our Mitchell-Lama projects from the ESD inherited portfolio. It's 62 units of family housing with a Section 8 HAP contract covering those units. For financing, we are using $7.1 million in taxes and bonds with a Mitchell-Lama House New York subsidy loan of $5 million, a little over $5 million. The borrower is the Michaels Organization. These are 10 two-story residential townhouses, and it will, all the upgrades will be energy efficient, and there will be significant rehab for the interior and exterior of these units.
Very good. Questions from HFA directors on this item?
Just striking that we're at 86 cents for the LIHTC.
I know. It's, we are working deal by deal to increase LIHTC prices, but it's not great. No.
So now before the board are resolutions to be adopted that were transmitted in connection with this item, assuming the first and second previously entered for the HFA boards. All in favor, please signify by saying aye.
Aye.
Aye. The motion is carried and the resolution adopted.
Item 9, resolutions authorizing financing approval of multifamily preservation program subsidy funds in an amount not to exceed $5,860,000 for Fort Hill residential preservation in Canandaigua, Ontario County.
Great. So this is another preservation transaction, but this is senior housing. The thing that I would note here is in our policy of trying to make every dollar stretch further, we have saved volume cap from this transaction, so the developer has gotten a conventional first loan, and we're only using subsidy to achieve the rehabilitation of this property. So this will be, as I said, senior housing, 57 units, and 55 of those are affordable to incomes below 60% AMI. The borrower in this situation is Conifer, and this is also a historic tax credit project, so it's going to receive federal and state historic tax credits. The two historic buildings were originally constructed in the early 1900s as the Canandaigua Academy and then converted in 1996 to senior housing. So these funds will allow for an upgrade of interiors and exteriors of these apartments, and there will be, in this transaction, the inclusion of a 21,000 square foot auditorium as a community performing arts center. So kind of an interesting project, and we're very proud of being able to save volume caps in this.
I'm looking, Nicole, for the picture. Yeah, it's this one. You know, it's really, I don't know if you've always done this, but having pictures in the board materials is really helpful. And this, when you just described it and you see the historic, nature of the property, and it's just going to be great.
Yeah, we're excited.
Plus, Canandaigua is a really nice place.
It is, yeah.
If you have any excuse to go there, you go to the ribbon cutting for this one, Ruth Ann.
Mm-hmm.
And say, any questions from directors for Nicole on this project? Linda?
Now before the board are the resolutions to be adopted that were transmitted in connection with this item, assuming the first and second previously entered for the HFA board. All in favor, please signify by saying aye.
Aye.
The motions are carried and the resolution adopted. If I may, Chairman, I think I made an error. And in approving the financing for the Main Street project, I forgot to ask for a vote of the committee. So if I could go back to that, just
Yeah, sure, of course.
assuming the first and second previously entered for the Finance Committee, approving the financing for $7,100,000 for Main Street housing, Town of Fallsburg, Sullivan County. Can we have a motion of the committee? Assuming the first and second previously entered for the committee, all in favor, please signify by saying aye.
So moved.
The motions are carried. Thank you, and the resolution's adopted. So now I apologize, we can go on to item 10.
All right. Good catch.
Okay.
Item 10 are resolutions authorizing the adoption of amended and restated resolutions regarding the agency's $182 million 7 West 21st Street housing revenue bonds and authorizing the issuance of up to $36,350,000 of taxable bonds for said project. Again, 7 West 21st Street here in New York City, New York County.
Correct. So, heading back to the city, this development was approved by the members of the board in May of 2015 to finance new construction of a multifamily rental building. It's two 18-story buildings with a total of 289 units, 58 of which are affordable below 60% of AMI. So these bonds were issued as unrated private placement bonds and were sold to Wells Fargo, M&T Bank, and TD Bank in 2015 and 2016 in an aggregate amount of $182 million. The project was completed in September of 2016. So the first request is for the agency to amend and restate the existing bond resolutions to incorporate certain changes with respect to the terms and conditions of the outstanding bonds. And Wells Fargo will commit to purchase all the outstanding bonds for a term of 15 years. So that's the first request. And the second request is for the agency to issue an additional $36.35 million in taxable bonds to pay for refinancing costs and to reimburse for construction costs originally funded with equity for the project.
All right, Nicole, thank you. Questions for Nicole on this project? Yes.
Yeah, the original bonds for this project were a combination of taxable and tax-exempt bonds, is that correct?
This is where I'm gonna ask for Joe, yes.
And what the issuance that's currently being requested authorization for, excuse me, will be all tax exempt, is that?
Taxable.
They'll be
All taxable.
I thought it was just the 36 million that was taxable.
It's confusing because the numbers
Joan,
are
why don't you
very
come,
close.
Joan, why don't you come up so you can be picked up by the
Yeah.
microphone?
Yeah, it's confusing because the numbers are kind of close. So the existing tax exempt bonds are very close in amount to the currently requested taxable bonds. So we're requesting to keep the existing tax exempt bonds outstanding. They'll be remarketed to Wells, and we will be issuing an additional $36,350,000 of additional taxable bonds.
So the only difference then for the I'm sorry, the 182 million is the difference in who the bondholder will be? That they're
Yes,
being sold
yes.
just to Wells rather than to...
Rather than to the consortium, right. There's some additional changes in the interest rates because this is a long-term holding period rather than the construction period.
Right, that was the other thing I was wondering about, excuse me, was what the impact on the interest rate would be with this change. Or of the debt service payment of the mortgage.
We
However,
can-
whichever way you prefer looking at it.
We can get you that information, I don't have it right
Yeah.
here. We can get you that information.
I'm just wondering what difference it makes, if it makes a difference in the building's finances, in the debt service coverage ratio, or in the loan-to-value ratio.
Whatever the new debt service is will be fully supported because now that the project is going into the
Other tenants.
stabilized
Yeah.
Right.
tenants, it's generating revenue. So it's a very different
80%,
metric
which
than
is
the
market rate
construction.
on Fifth
Right,
Avenue.
so we actually know what the income is now. and
Yes.
that's
It's not a-
just
Yes.
theoretical projection. The other question I had was in regard to the 36 million, which will pay for the refinancing costs and a reimbursement of the construction costs,
Of certain
which
construction
were
costs.
originally owner's equity.
Yes.
Will the owner have any remaining cash equity in the project?
Yes, they will.
I don't have the numbers in the memo, but my recollection from the credit committee conversation of this project is that the loan to value.
It's about 58.6%.
I mean, it's
very low.
Very
Yeah.
low loan
Yeah.
to value, so it's a very safe project, so yeah, there's a good amount of equity in this project.
Okay.
Joe, thank you. Nicole, thank
Yeah,
you.
it would be helpful when we were looking at something like this if that was given to us.
Sure, absolutely, we can make sure that gets that.
Yeah, because it's the original document, you're thinking about the original.
Yeah.
document.
Yeah, I mean, I
Right.
can't remember what
Yeah.
it was in
Good.
2015.
Yeah,
Yeah,
exactly.
it's a while
That's
ago.
fair point. Fair
Okay.
point. Great.
Thank you all.
Well, don't go, yeah, we haven't voted.
Ah.
You gotta stay for the formality of this. You don't get off the hook. so
We don't know how the vote's gonna go.
Yeah.
So now
No.
before the committee and the
Oh, aren't
board
they
are
confident?
Could make it
resolutions that were
interesting.
Can I say
transmitted in
58%
connection
again?
therewith.
Yeah, let's just vote no, just for the sake of it.
Assuming the first and second previously entered for the committee, all in favor, please signify by saying aye.
Aye.
The motions are carried and the resolution adopted. Assuming the
Close
first
one.
and
Okay.
second entered for the board, all in favor, please signify by saying aye.
Aye.
Thanks,
The
everybody.
motions are carried and the resolution is adopted. One more consent. Oh, you have to go. We've got.
Thank
Yep.
you. Nicole's got,
Yep.
Nicole and Ruth Ann need to leave. Joe, thank you.
Thank you.
Linda, back to you. We're wrapping up, people.
The last item for discussion today is a consent item, a resolution approving a technical assistance and consultant services agreement to assess the feasibility of creating a WBE loan program and technical assistance program. If there are no questions now before the board for approval is a resolution of the New York State Housing Finance Agency approving a technical assistance and consultant services agreement to assess the feasibility of creating an MWB technical assistance and loan program, revolving loan program. And I will just note that the resolution will be amended to expressly state that we're funding this program out of our liquidated damages that we've collected from developers who failed to meet their MWBE goals. So assuming the first and second previously entered for the HFA board, all in favor, please signify by saying aye.
Aye.
The motions are carried and the resolution's adopted.
There being no further items for the HFA Finance and Program Committee and the HFA and AHC boards, Linda is going to ask for motions and seconds to adjourn. Before she does that, I want to thank Eric Mostert from Tax and Finance, who has been sitting there with Todd. And people know Eric is the CFO for one of the most important agencies in New York State. He's really not supposed to be here because we're in filing season. And Eric and his colleagues up at State Campus, there are about 5,000 of them now, have to collect, how much, Eric? $110 billion this year? What's the number?
We're going for it all, Chairman.
So thank you for joining us on behalf of our colleagues at Tax and Finance. And nice to see you, Eric, as folks can tell, former colleague and friend. Hope you're doing well.
Thank you, sir.
Linda?
All right, assuming the first and second previously entered for the HFA Finance and Program Committees, I think we only had the Finance Committee today. All in favor, please signify by saying aye.
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 The motions are carried. The committee meeting is adjourned. Assuming the first and second previously entered for HFA and AHC boards, all in favor, please signify by saying aye.
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 The motions are carried and the meetings are adjourned. Our next meeting is scheduled for Tuesday, April 12th at 9 a.m. to be followed by an educational session.
Linda, thank you.
April already?
Thank you, everyone.
Yeah, I know.